I think Ben Carlson talks about this a lot. He's a really interesting writer. He says that this new access to the stock market, this universal access to the stock market, may may affect future returns in the sense that we're not going to see what it's about 10% is kind of the historical average of the S&P 500, give or take. That can't really be guaranteed in the future because so many people have access to the stock market now compared to if you're talking about the 40s and 50s when it was literally the top 1% or the top 0.1% that would have access to stock market back then. Now, I'm not sure if he's right. I hope he isn't, but it carries a bit of weight. Like, what do you think in terms of that?
Well, it's an interesting point. I think that, again, to go back to the example I just shared, there are people who started out investing, and unfortunately for them, they started investing at the wrong time. It was a rough market. And so, we've had probably throughout time, and certainly in the last few years, a number of people who have started investing. It didn't go well for them. And then they said, that's it, I'm out. They washed their hands of it. They're no longer interested in investing in the stock market. So I think that it provides one counter to Ben's argument, because it's not going to be a straight line up. And I think for a variety of reasons, we're never going to have absolutely every, there's never going to be 100% participation in the stock market. The other thing is, I do wonder if we start to see a little bit of, I don't want to say the pendulum swinging all the way back in the other direction in terms of the cost of trading and sort of what happens for individuals. But I remember 4 or 5 years ago talking with a financial planner. I was at a conference, was chatting with this guy, and I asked him, what's your biggest challenge as a financial planner? And he immediately answered that for him, it was figuring out how to communicate with his different clients and prospective clients. There were some clients who very much wanted to talk over the phone. There were younger clients who did not want to talk on the phone at all. They just wanted to do everything by text, and a website and a platform and that sort of thing. And so I think that's one other counter to Ben Carlson's argument. Everybody's different. Everybody has different goals, and different levels of comfort in terms of what they're interested in investing in. So I think that's always going to have an evening out effect on the market.
Absolutely. And another one of favorite phases from Ben Carson is we just don't know what's going to happen either. So there's no point gluing yourself to these kind of predictions. Okay, you mentioned the manias there and the wrong times to invest. So I'm going to bring that up because I think you've witnessed all three of the latest crashes over the last 22 years, we'll say, between the dot-com bubble, the great financial crisis, and then the COVID crash, which was more like a flash crash, but it did feel very real at the time. Do you think retail investors' reactions to these kind of rapid downturns have changed over the years, or does it follow a similar pattern?
Has it changed over the years? Yes and no. When people start investing has a huge impact on how they approach it. And, there are people who start right before a crash. Maybe they start 6 to 12 months before a crash, whether it's the late 90s or 2008, 2009. And risk tolerance is something that we as human beings tend to overestimate when it comes to the stock market. We think we can handle a big drop, and then a big drop happens. And then you find out, like, well, wait a minute. It's easy to say in theory, oh, yeah, if the market fell 30%, I would sleep just as well at night. But then the market, as we've seen several times, drops 30%. And then you find out what your risk tolerance is. I think for those who make it through, as I mentioned, there are people who they have a bad experience and they tap out and they say, that's it. I'm never doing this again. I'm just going to stick my money in a basic savings account or, buy real estate or find some other investment vehicle that is not the stock market. But for those who make it through, I'll just speak from my own experience. It does toughen you up. It really does, steel you for whenever the next crash is. I want to be very clear, Mike. It never feels good. I mean, as experienced an investor as I am, and I've been investing for, I'm now in my 4th decade of investing. 2022 didn't feel good.
No.
I mean, it felt really bad to just see.
We're two different poles here now. I think I'd invested for 3 months at the time 2022 came around, but it didn't feel good then either.
Yeah, and so it is one of those things that you have to always keep your eye on your own goals, your own time horizon. Understand that we collectively as investors have been through this before. We will go through this again and again. If you've got the stomach to make it through those really rough times, and you can invest for decades, then you will absolutely reap the rewards.